So in Blackboard, so I need hopefully get a volunteer to do this for us. Under contents, under exam guides and reviews, I gave you last semester's question 2 from the exam. So if someone wants to answer that between now and Wednesday and let me grade this, let me know. So you've got that problem to work on. It's not, it's a 30-minute question. You can probably do it under 30 minutes. Looks real familiar, right? You have a scenario, you have a list of asset classes. So real familiar stuff. So see if you can work on that. What's wrong with the muni bond and corporate bond yields, right, versus the current? We know muni bond yields have been higher than corporate bond yields. We don't know why. On the exam, I will probably rig that. So even if they are higher, I usually use the actual current rates, but even if they are higher, I'll probably flip it so they're not. Because it's pretty obvious if muni yields are higher, your work is done, isn't it? There's no reason to buy the corporates if you can get similar duration, similar corporate credit risk with municipals with a higher yield. So I'll probably rig that number. What's missing from the list? One thing you're going to talk about that's not on that list. And Noah and Evander, make sure you get your papers before you leave today. Your paper grades. What's missing? Blank versus black. It's not on the list, but you have to talk about it. Probably. Bonds is half of it. Stocks versus bonds, right? You want to know, because I don't put that on the list because that's just a given. You always want to talk about stocks versus bonds. So that's a pretty critical one, right? We have any volunteer now to do it, or do you want to read it first? Let's see. All right. Okay. Let's get into today. We want to talk portfolio expenses, the expenses of investing, and then get into some number crunching. So there is a lot of number crunching in the second half of this class. Most of the stuff we're going to do now is going to be number crunching. So expenses with investing. This is something that has been changing dramatically over time. Expenses for investing is much, much lower today than it was back in the 70s. I may have told you about this, but I mean, it's really interesting if you read Jack Bogle's history of him fighting hard to reduce investment expenses for his customers and him actually being sued by the industry and say, you can't do that. You're not allowed to charge less. You have to charge at least this much. And he's like, well, this is my business. I'll charge what I want to charge. And fortunately, he won that case. So we actually had a time in our business where it was like people were fighting to charge more and actually suing people for not charging more. So if you're going to do it yourself, you're going to have to open a brokerage account. We talked about that. Start your own brokerage account, even if it's play money. Even if you're just kind of making pretend trades. Your cost will be a cost per trade, but right now that's essentially zero with a few pennies that you may charge on a few transactions. But essentially, it used to be $5, $10. I mean, I remember it used to be $50. Then in the 90s and 2000, it started dropping, and then you started seeing $5 trades. And now, because of Robinhood, it's just Schwab, USA, when they had a broker, they probably still have a broker. I don't know. Ameritrade, they're all going to zero commissions. So how did I make money? And that's the thing now, right? They got to make money off of the margin accounts and those type of things. Some people say they're making money by selling your trade information to the big hedge funds, and there's been some complaints about that. So maybe there's some questionable activity going on. But that used to be a big part of the cost for small investors. Large investors had a huge advantage. So our trading as a small investor at $5 to $10 at USA, and if I did a trade for, like, let's say we did $1 billion trade, we're going to be paying a small fraction of that. It would be much, much cheaper. The other thing you have, which today is the most important one, is the bid-ask spread. So the bid-ask spread, we can even look at it. Markets were recovering today, weren't they? Did they end up? Yeah, they were down quite a bit, over 1%. So if we look at a stock, let's look at, I don't know, Apple. Okay, so Apple, you can sell it for 164.81, or you can buy it for 164.85. There's a 4-cent difference. If you do a round lot trade, 4 cents. Who gets that 4 cents? That's where the the brokers make their money. 4 cents, they have some risk right in between setting all this up for you and that kind of thing. So there's it's not entirely just free money to them. And then you get another company. I have no clue, but I'll put GameStop in there. Bid and ask, what do you notice about their bid ask? 19 cents and 19 cents on a much lower price stock. So it means when you buy GameStop, it's percentage wise, it's going to cost you a lot more than if you buy Apple. Why? Because GameStop's not as liquid. And then this weekend, I should mention, Juan Carlos's brother and 4 other UTSA students, they went and competed in the CFA Research Challenge, which is about 1,000 schools throughout the globe, and there's 21 in our region. They're competing to make it to nationals. And how do you think they did? 4th place, 7th place. They're against UT Austin, Rice. First place. They won the entire thing. So that's pretty good, right? UTSA doesn't have to apologize to anybody. But the company they did was called CC Environmental. They were recommending a sell on them. Look at their bid ask. Anything stand out there? I would never buy a stock like this. They should add this. You need to tell your brother, you need to add this bid ask to their analysis. That's pretty ridiculous. Are you going to buy a stock for $7.50 that if you turned around 10 minutes later to sell it, you would sell it for $5.26, and you'd be doing that? That's a pretty hefty loss, isn't it? In just a few minutes. Okay. Illiquid stocks, not a lot of volume there. No one's buying this stock. So that can be huge. You want to watch that. I always watch bid ask anytime I do a trade, because if it is really, really wide, I'll probably not do the trade because I know something's going on I don't know about. And I'm a little nervous that I'm dealing in something where I can't really trust the price. So you as a small investor, that's probably the most important thing for you to look at. What about a large investor? A large investor hasn't worried about the bid ask, but they usually, at USA, we always got something in between. We always had to make sure we got good execution. So we actually did pretty well. We actually did better than the small investor because of the size of our trades. The biggest cost we had is called market impact costs. You don't have a market impact cost as a small investor. It's large investors who have market impact costs. What that means is you're a large investor, so you need to buy or sell millions of shares. And guess what happens the second you say you need to sell 1 million shares? What happens to the price of that security? Suddenly there's all the supply, the price of security is going to fall. You're going to get a lower price than you wanted just because you drove the market down. So that's called market impact costs. I've never had market impact costs. There's never been a trade where the market goes, oh, Ron's selling, the stock price drops. That just doesn't happen. I can't even think of my largest trade ever would have caused that. At USA, though, we probably did. There's one day we did a trade and we got an article the next day that this ETF had become really popular. And it's all because we did $1 billion trade the day before. I was like, no, it's not popular. We just were parking some cash. We probably moved that securities price. So you have this supply demand imbalance. Suddenly someone wants to buy 1 million shares. Suddenly on another day, someone wants to sell 1 million shares. Those large trades. Trade volume is important. If a stock has a really high trade volume, it's going to have less of an impact. Large investors often will hire what's called a transition manager. We did that several times at USA. And what we do is we hire them and say, do your best. We got a large trade to do. Do your best to do these trades without harming the market. So there's once, when we took over the 401k plan for USA, we decided to fire all the existing managers and hire all new managers. We did that for the pension plan and the 401k plan all at once. So that's like $5 billion in assets. We're going to sell everything. And we're going to buy new stuff. Well, that's kind of painful, isn't it? We don't want to kill those stock prices because we sell stuff and have to buy them real expensively. So what they did is, I mean, you can kind of guess. We're going to fire manager A or we're going to hire manager B. What would be the first thing you would do? This is a large cap manager. What do you think the first thing you do? You maybe look and see if they have the same stocks. If they have 1 million shares of Apple and they want to buy 1 million shares of Apple, maybe we just transfer that, right? That's the first thing you do. So this manager gives their list of securities. This manager brings their list of securities. The first thing we do is match that up. That might be 30, 40% of the portfolio. Then what do? Well, we usually use State Street as our transition manager. State Street goes to their index managers and say, hey, you do trades where you don't really care about the market. You know, you're just rebalancing your portfolio. Any trades you're doing today? And they say, yeah, we got 100,000 shares of this. And they'll say, hey, tell you what, you don't want to do 100,000 shares because you'll move the market. We don't want to do 100,000 because we'll move the market. Why don't the two of us in a day, we'll just swap our 100,000 shares at whatever closing price is, and there's no market impact. So both sides are happy, right? Because they matched up their trade. So that's what in a transition manager would do. They'll come back at the end of it and they'll show you how much money they saved. In reality, you have no idea if they saved you anything. Because what they're telling you is what the impact could have been if they hadn't done everything they did. You have no clue. It's really kind of a trust thing. Small cap managers, because they have much smaller trading volumes, they'll often close their funds when they hit like $1 billion. Say, once we hit $1 billion, we're not doing this fund anymore. That's pretty wild, right? Because how do they make their money? It's their management fee times their assets. And yet they say, we won't take any more than $1 billion. So they're essentially saying, hey, you know what? We're willing not to make as much money because we don't want to mess up our fund. And so they'll actually just stop at that. So market impact can be huge, especially if you know you have some big trades. There are some investors out there. I forget the one in particular, but I can't remember the firm. But what they did is they looked at Fidelity's biggest funds and they tried to figure out what Fidelity was doing so that they could guess Fidelity's trades before they did them. And then they would what's called front run them. So if they knew Fidelity was going to sell 1 million shares or something, they would short those shares before Fidelity did that. If they knew Fidelity was going to buy a bunch of shares, you could buy them before. And there was one firm we talked to that was 100% of their investment strategy was front running another firm and trying to figure out. Obviously, Fidelity's going to go, well, we don't want you to do that. That doesn't help us any. So anyway, that's expensive with investing if you're doing it yourself. If you're going to hire a manager, then you're going to pay their management fee. And we've already seen some of those portfolio management fees. Sometimes they can be really high, like a hedge fund might, or a, kind of any kind of high octane type of management firm might be 2 and 20. They're going to charge 2%, and then they'll take 20% of the profit. Those are somewhat going away, but that's somewhat of the typical hedge fund. Just they charge a lot of money. It's kind of nice, right? You make 2% of assets, and then if you have a good year, you get another 20% of the profits. That just sounds too good to be true. You might have a 1% fee, but whatever your fee is, we'd already talked that, that's a big one. That's an easy one to avoid overpaying. You just compare managers. I don't think I'd ever pay more than 1% on a mutual fund. Even 1% to me seems really, really way too high for a mutual fund fee. And then some of them charge front and end and exit loads. I would never pay a front end or exit load. There are some funds like Washington Mutual or BlackRock that have front and exit loads. But that's because they're for institutional investors. And they say, hey, if you want in our fund and you're a retail investor, you can do it. And you got to pay a 5% upfront. And so obviously you wouldn't do that, but there may be some people who say, hey, I really want BlackRock, and they would do it. There's no evidence that charging more for mutual funds means they have better performance. There's just no evidence at all. There's no relationship between, I mean, there's a relationship after fees that low fee funds do better than high fee funds, but there's no evidence before fees of that case. So obviously after fees, low fee funds do better because they have an advantage. Their return's going to have less fees subtracted out, but there's just nothing that proves that passive investing is the lowest expense, and it usually has materially outperformed active management over time. All right. I was going to show you all the latest study from S&P on active management, but I can't get my access to it. If I can find it in the semester, I'll show it to you. They usually update it. They always have an incentive to show that passive does a lot better since they sell the leading indices. But the last one I saw, it was 85 to 90% of the time, or 85 to 90% of the managers out there were beat by the indices. You would have been better just buying indices. And then the question is, well, why don't we just hire those 10% managers? Well, the problem is just because they beat the market the last 3 years doesn't mean they're going to in the future, and there's no relationship there. So if I were you, I would, your parents, your grandparents should probably be passive investors. There's no evidence, unless they have 60 hours a week and have a degree in finance and maybe a master's degree in mathematics from Wharton School or something, they probably should just be going passive because it's an extremely more difficult market. But in my risk management class, those are taking that, they're actually going to do an exercise on that later in the semester to do that type of analysis. So I can find an updated report, I'll show you. S&P does one. All right, that's it on expenses. Let's talk about returns. So now we're going to get your calculator out, probably for the first time in the whole semester, and then you'll use it a lot for the rest of the semester. One of the most amazing things about retail investors is most of them don't know what their return was. They don't know how their portfolio did. It's not even asked that they beat the market. They don't know what their return was. The market was up 10%. Well, I don't know what the portfolio did. There's been many studies that people who think they made money actually lost money, but they just didn't know how to calculate it. I spoke to one group of an investment group, and they talked about how great they were doing. I just didn't believe it. First of all, because the formula for calculating return is quite complicated. I'll show you the modified deeds formula. It's not an easy formula to do, so I don't actually think most people can even sit down and actually calculate that return. You got to collect a lot of data. You got to update it, and it's pretty tough to update it if you got 50 stocks. If you don't have a link, you could probably write a Python program. You can link up the Bloomberg, but unless you want to manually key a bunch of prices and dividends and dividend dates and all that kind of stuff, it's not an easy thing to calculate. So most people don't know. Now, if you have a 401k, your 401k is going to give you a return for that particular option that you're in. They may give you a return on your portfolio. I'm not sure how accurate those return calculations are, but they're probably ballpark fairly accurate. But what we're going to do, it's kind of a three-step process. The first thing we're going to do is calculate what we call the holding period return. Once we get that holding period return, we can then take it and link it and do other type of analysis. We can annualize it. We can calculate risk statistics on it, like beta and standard deviation. So the holding period, you just pick some time. The most common is monthly. Most people calculate a holding period for a month. You can do it daily, you can do it weekly, do it monthly. At USA, we did stocks daily and bonds monthly, just because it didn't make sense to pull all those bond prices every single day. But most people monthly. I do my return on a monthly basis, although I update it daily, but I calculate it, the official numbers monthly. So I'm going to show you a simple holding period return And then I'll show you what's you should actually use. And then I'll talk about what's wrong with that one too. So there's issues with all of these, but here it is. A simple return is you take your ending market value minus beginning market value. That makes sense. How much is your price up? You add to that accrued income. What does accrued income mean? It means it's income whether you got the cash or not. It's income that belongs to you. So with the bond, you know, with the bond, you probably did it in your accounting classes. Bonds pay every 6 months, but you're going to count 1/6 of that until you get your money. So that's accrued income. For stocks, when is it your money on a stock? It's up there on that page, but on a stock, they pay dividends. So is it your money when they declared a dividend? Is it their dividend, your dividend when it goes X dividend, or is it your dividend when they pay the dividend? When would you accrue it? Announcement date, X date, or payment date? You would think payment date, but the way the rules work, anybody want to argue for another one? I would have thought payment date, but because you think, well, if they change their mind, then, you know, I don't get it. So let's wait and I'll get the money. But which date might you pick? Announcement date? Yeah. Maybe. But the announcement date says we're going to pay a dividend, but it doesn't say to which stockholder. Because what if you sell your stock tomorrow? Are you going to get that dividend? Maybe or maybe not. How do you know you for sure going to get the dividend? If you own the stock when? On X date. If you own the stock on X date, you will get the dividend even if you sell it tomorrow. All right. So I agree with you, Barney. I mean, when I got the dividend, I got the dividend. But the way it works, if you own the stock on X day, you know you're getting the dividend. So once you make it to X day, it doesn't matter when you buy and sell the stock. That's your dividend. So we're going to put this dividend into the month that it went X. So that they may have announced in November, it went X in December, and they pay in January. We're going to accrue that into December in our return calculation. Right? With bonds, we're not going to do bonds in here, but bonds, you essentially just, you know, probably in the accounting classes did the interest method. It's kind of an accrued method, kind of income on income kind of a method, but we're not going to worry with that. So that's the simple approach. Let me show you modified dates, which is a little bit more sophisticated. And it's actually what the CFA recommends. So what modified dates is saying is, and the simple formula completely ignores this. Is the reason you can't use the simple formula. What modified deed says, okay, you started the month with 1,000 shares. You ended the month with 1,500 shares. So you obviously bought 500 shares during the month. So when you bought those 500 shares, to be really, really material, right? You might have bought those shares. Maybe you started the month when the stock was at I don't know, 40 bucks, no, 230 bucks. You have Facebook, you have 1,000 shares, and then it falls down to 190 bucks and you buy 500 more shares. That's pretty good, right? Buying those 500 shares after it dropped. Maybe you bought it because it dropped. How do you calculate the return there? Well, what modified DEET says is we're calculating this return from the portfolio manager standpoint. You as an investor, the fact that you walked in and bought more of our mutual fund right in the middle of the month, we didn't have any control over that. That was your choice. So you walk in, you buy more of a mutual fund. So let's say you started with $1 million in Fidelity at the beginning of the month, and you go out and you buy 500,000 more of Fidelity. Fidelity's going to say, hey, you chose when to buy that. We didn't influence that. That shouldn't affect our return. So what the modified DEET is trying to do is take the timing of your cash flow out of the calculation. Now, do you care about the timing of your cash flow? I think absolutely you do care. But the modified DEET is saying, yeah, but we're not measuring your performance. We're measuring the portfolio manager's performance. And we can't have your decision when you invest your money mess up our return. All right. So that's what modified DEET is trying to do. It looks somewhat similar. So ending market value minus beginning market value is the same. It looks like they're subtracting income, but when you look at this bottom, they're adjusting for that. And what they're doing down here, which is the most important part, is they're adjusting for the timing of the cash flows. All right, you don't need this formula for this class, but if you want to see this formula, we use it in the investment society on our portfolio so that we're following CFA standards. I don't know if they have the CFA in here. There it is. Well, no, just in the, yeah, it's just in the footnotes. So the CFA, wow, there's probably some Python programs or something you can do in here. They have some examples as well. So the CFA says the modified dates is required. You have to do that. But again, you're not telling the customer what their return is. You're telling the customer what their return would be if they had no cash flows throughout the month. All right, we're taking that time and the cash flows out. So if you start off with $1 in a mutual fund at worth 20 bucks, and you go the whole year in December, you put $1 million in, and right after you do that, the mutual fund drops 20%. Your return is going to look a whole lot better than what you actually did, because they're going to take that $1 million out and assume you didn't do that. So you care what your actual return is. The portfolio manager is saying, hey, we've got to adjust for your cash flows because that's your decision, is not mine. I don't necessarily agree with that, because there's a lot of portfolio managers out there that do talk up their funds at the worst possible times, and they do influence when you put your money in. So I don't think we're as innocent as we want to say we are. All right, so let's just try this. What stock do you want to do? You want to do Seiko since it's up there? Maybe not. Let's do Facebook. I forget what company I said before, but I meant to say Facebook, which is no longer Facebook. That's not Facebook. What's it giving me? Is that? No? Let me do the ticker. There's a company named Facebook. Who is that? Wait, wait, I'm curious now. Who in the world is that? Okay, boy, I don't know what I pulled up just back then. All right, so I was really worried because I owned some Facebook, and I think that said 180 bucks, didn't it? And I was like, uh-oh, I need to cancel class and go. All right, so here's Facebook. Let's bring in some historical data. And let's do, wow, our word, look at that, 319 bucks. So let's do the return for January, all right? So we need an ending market value. What would be the ending market value for January, would you guess? So this is open, high, low, close. What would you use for January 31st? Just yell a number out. 313.26. That's the closing price. What was it? 36? 26? Any market value? All right, so I might trick you on the exam, but what is the beginning market value for January? What date would you pick? December, exactly. December 31st, if that was an actual market day. Yeah. So we don't use January, beginning number in January, use the ending number of December. All right. 336.35. I didn't own Facebook back then, fortunately. All right. I don't even know if Facebook pays dividends. I don't think they do. So there's no dividends. So that's all we need, right? Now, let me show you a company that does pay dividends. So here's Walmart. There's a dividend right there. So the question is that announcement date, X date, or payment date? What would you guess here? What is Yahoo Finance showing us? What's the most important number date to us? It's X date. And that's what they're showing is X date. All right. They always show X date. Why? Because on X date, the stock price will fall by the dividend amount. Because you know, if you don't own the stock tomorrow, you will not get that dividend. And so the stock price will actually fall. If you own it today, you're getting the dividend. You're getting that 55 cents. That means that company is going to be smaller by 55 cents. They're going to send out 55 cents per share out of the company. So the company value has to come down by that 55 cents, doesn't it? You can't send out all that cash and not come down. So your stock price falls 55 cents, but you're okay with that. Why? Because you can get 55 cents in cash. The next day when you buy the stock, you get a discount for 55 cents. Say, wow, I got it for 55 cents cheaper, but you're not going to get the dividend. So it's great you bought it for a cheaper price, but you don't get the dividend. So essentially what they're doing is saying, hey, X date is when you're getting the dividend. The stock market's going to reflect that. So stock will fall. Now, it may not actually fall in practice because there's other things driving their stock besides the dividend. It's just that their stock would have been another 55 cents higher if this dividend had not taken place. I'll show you that with there's one stock that I'll actually show you the numbers. I should put it in my presentation so I can remember it. All right, so that's the date that we're going to use for the X date is whatever Yahoo Finance shows, because that is actually the X date. There's one stock, it was a $40 stock that declared a $10 dividend. Is that a big dividend? $40 stock. And you can see it. I remember we had that stock in our portfolio, and in one day the stock price fell $10. We're like, my word, what happened? Did it announce something? Is the CEO saying something or in the news? And we looked it up as, oh, the $10 dividend just went X. No problem. It fell $10, but we're going to get $10 in dividends. We're okay. So it's pretty obvious when you see a big dividend like that, that it comes out of the price. You can't tell with an individual stock. So for Facebook or Meta, you're going to take ending market value minus beginning market value plus income and divided by beginning market value. So that's going to equal 313.26 minus 336.35 plus 0 divided by 336.35. So they fell 7%, and their investors are going, wow, January is bad. And you're thinking, yeah, just wait. hasn't done anything yet. How did they do in February? Ending market price. Now, what is the adjusted close versus the close? Am I in Walmart? Yeah, I'm in Walmart. So let me go back to Facebook. The close versus adjusted close, what that is it's actually pretty helpful for you. The adjusted close is taking that dividend and essentially reinvesting it for you into the stock. So if you use the adjusted close, you can actually come up with a pretty good actual total return of the stock. That includes the dividends. If you use a close, your return will be understated by the dividend. If you use the adjusted close, it adjusts for that. You got to be real careful with mutual funds. Mutual funds do the same thing, but the mutual funds on Yahoo Finance, they do not adjust for capital gain distributions. And so if you use Yahoo Finance for mutual funds, it will grossly understate returns because it doesn't show those capital gain distributions. But that's the difference. If you're trying to figure out the true return of Facebook, since they don't pay dividends, it's not a big deal, but you use the adjusted close because that way it's as if you've got the dividends, you reinvest it into the stocks. So, all right, so their close is 211.03. What's their beginning value? Do I need to look that up? Don't we have it already? What's February's beginning market value? January's ending market value? All right, so how's Facebook done this year? I can't remember what I bought it at, but it was somewhere in this 211 neighborhood. I think I somewhat broke even since I bought it. If you want to know why I bought it, I can, give you my philosophy. One thing we can say for Facebook, which I think is pretty interesting, is this is essentially a value stock now after being a growth stock for most of its life. That's a very cheap stock. A 15 PE when the S&P is at 20 something, that's a very cheap stock. So you consider Facebook to be a slow growth, old economy stock? That's what the stock market's telling you. I mean, it's not that cheap. That's a cheap stock, right? There's Ford Motor Companies. Ford Motor Company, an old economy, slow growth company. They're producing EVs, aren't they? They have some pretty good. Isn't the Focus? Isn't the Ford Leaf a pretty decent EV vehicle? But that's a really cheap stock. If they just can maintain what they're doing, you'll make a fortune of Ford. So the market's not just saying they're slow growth. The market's saying essentially they're going out of business over the next 25, 30 years. So, but Facebook's pretty cheap. I mean, especially compare them to say Amazon, 47 PE. So right now you can buy $1 of Facebook's income for 1/3 what it costs you for Amazon. So in Zoom, how's Zoom doing? I think they've come down quite a bit. So Facebook's a lot cheaper than these other tech companies. All right. So let's do another stock. What we want to do now, but this is our holding period return. And we're doing monthly, so that's 1 month's return. The question is, once we get a bunch of holding periods, that's a holding period for January. That's a holding period for February. Once we get a bunch of these holding periods, we can now put them together and do a lot of analysis. So what company do you want to do that on? So anybody have one that pays dividends that you're interested in? Has to pay dividends because I want to put the dividends in there. Why don't we try one that's really strange on dividends, and that's Costco. Costco is one of the most bizarre companies. If you look at their dividends, what do you notice about their dividends?
They're at the highest right now.
They're pretty high right now, but anything stand out? They paid a $10 dividend on December 1st. Do you think that's going to show up in the December 1st? Let's see if we can see it. Oh, that's 2020, right? Can you see it in the stock price? $10 dividend, the stock price fell, not quite $10, but it definitely fell, right? So they actually did pretty well. Now, $10 is not nearly as big as the other company I was talking about where their stock price was $40. When your stock price is $40, you pay $10 dividend. Much different than if your stock price is $300, but you can definitely see their stock. So if you own Costco, you're going, oh my word, my stock is down, 2% or something, 1.5%. It's like, what happened to Costco today? Well, you actually did really, really well at Costco today, right? Because you can get a $10 dividend and your stock only fell $4. You actually did pretty well. So let's do this one. This is a good one to do. That is X date. So let's do Costco. November, December, and January 2020 and 21. So we need any market value, beginning market value, the income. So what's the beginning market value for November? 357.62. Can y'all see that? October 31st, 357. We don't want to do the adjusted price because we're including the dividend in our calculations. 357.62. I should copy that because I can't remember anything I said 3 seconds ago. All right. That was our beginning market value, right? Let's get our ending market value. Someone yell it out if you see it. I'm hearing some of the numbers, but I can't, my hearing is pretty bad. 399.77. All right. How do I do pay special so I don't have to do all this? There's got to be some button. Ugh. Bill Gates. All right, what's my income in November? So what are you looking for in November? Y'all see any income in November? October there was nothing November, so their income for November is 0. So their holding period return is going to be ending market value minus beginning market value plus income divided by beginning market value. Had a pretty good November 2020. What's going on in November of 2020? Pre-COVID, post-COVID? Post, right? Second wave or no? Second wave was 2021. When was Delta? Delta's 2021. Did we have a second wave in November? They were certainly benefiting from the lockdowns. All right. What's my beginning market value for December? Any guesses on that? 391.77. Does that sound good? What's my ending market value for December? $376.78. I don't know why it does that. So it looks like they had a bad month, right? But did they have a bad month? Why didn't they have a bad month? So they paid a ridiculously high dividend. So how much is their dividend income there? $10. Now, if you're doing the modified dates, you have to actually put the exact date the dividend was paid. The fact it was paid on December 1st and not December 30th has a pretty big impact, but we're ignoring that. We're using a simplified formula. All we care about is the month. So they paid a $10 dividend. So they still lost money, but not nearly as bad. So I guess I'm thinking the other example where it was a 25% dividend. All right, and then our beginning market values can be December's ending market value, and then we just got to get January's. See if you see any dividends. Doesn't look like it. So we had a horrible January. 354.43. 352.43, whatever I said. All right, so there we've got the holding period returns. So how did I do overall? You started with 357, you ended up at 352, but you got $10 in dividends. Looks like a pretty small return. What was your income for January? 0. So all right, so that's what a holding period return is. So what do we do with this? All right, so now we need to do some averages. There's two type of averages. There's arithmetic and there's geometric. And I don't know why the R's are like that. Maybe I'm just spelling them wrong. But arithmetic is real simple. It's the average you learn probably in 3rd grade. You just add the 3 numbers and divide by 3. So the arithmetic average, you just take November's, December's, and January's, divide by 3, and there's your return. Made 0.6%. You're really happy in November. You're telling all your buddies what a great job you did. About Costco, you guys just aren't very good investors. I'm up 9.6%. And then you see them again at the end of January and like, hey, how's your Costco stock doing? I made money. But yeah, I mean, why didn't you get out at the end of November? All right, there's the arithmetic. The other way you can do this is use Excel, and Excel is just the average function, right? Exact same thing, just the average. So arithmetic is just the average. The arithmetic average is the normal average. So this is the monthly average. We can annualize that because we don't usually think in terms of month. We like to think in terms of years. Well, annualizing the arithmetic is you just take the monthly times 12. What if we're doing weekly? What would you do? Take the weekly average times 52. Okay, so that's what you do. So all you have to do is just take that monthly times 12. And there's my annualized average, 725. Now there's a serious problem with that. We'll talk about here in a second. There's your annualized. Can we annualize these returns? Yes, under certain circumstances. Now, geometric is a little more difficult. What we're going to do with geometric is we are going to link the returns. By linking, what we're going to do is say, okay, let's say you have $1 and we invest it in Walmart. What would we have at the end of the month? So we have $1 and we'll make 9.55%. We'll end up at end month with what, $1.955? So that's what we end of November. What do we do at the end of November? Well, we take that $1.55 and we lose 127 on that, which means what? We don't just lose 1.27% on our dollar. What do we lose 1.27% of? $1.09. So we actually lost a little extra money, didn't we? All right, so it's a little more conservative. And what do we do in January? We lost another 6%. So at the end of November, we had like $1.955. We lost like 1% of that, so maybe you have $1.07. Now we're going to lose 6%, not of the dollar, but of the $1.07. So if we started with $1, we would have ended up at $1.01. But that's not our monthly average. That's how much we have over the 3 months. How do we put this on a monthly basis? You take all of that and you raise it to the 1 over n. What's my n here? 3 minus 1. All right. So you add each month. Take those added numbers, multiply them all together. You take that entire figure to the 1 over n minus 1, and that gives you your geometric. So a little more complicated calculation, right? Hopefully you know this formula, because in finance we use this formula a whole lot. I don't know how many millions of times I've done this calculation. Very, very common. All right, so one thing you can be absolutely sure of, the geometric average, not the annualized, but just the monthly average, will always be lower than the arithmetic. It has to be. Geometric averages are always lower than arithmetic averages. Did that work out this case? Yeah, the geometric is lower. And I'll show you why that is. It has to do with standard deviation. In fact, the more volatile the returns are, the further these two numbers are going to be from each other.
Even if you have 3 consecutive gains.
Well, if the standard deviation is exactly 0, in that case, that will be the same. That's the only case of the same. But if 1 month is a little higher, oh, there it shows higher. I don't, you got to do the, yeah, I mean, it's pretty close, right? So geometric is 266, arithmetic is 267. Anytime there's any standard deviation at all, any volatility at all, the geometric must be lower than arithmetic. The only time they can be the same is if standard deviation is exactly 0. In that case, they'll be exactly the same. All right. How do we annualize the geometric? Well, watch this. I'm going to take this entire formula. Uh-oh, I hit the scroll button by accident. We're going to make one change to this formula. What do you think is that change going to be? We can make one change, or you could say we're going to change a 1 to something. Which one are we going to change, and what are we going to change it to? So it's going to be 1 over 12 or 12 over 3, or how would we do it? Not 3 over 12, but it's close. It's going to be 12 over 3. So when you annualize it, the bottom is how many months you have. The top is how many months there are in a year. So you're always going to raise it to 12. What are we doing weekly? The bottom is going to be how many weeks you have. The top's going to be 52 because there's always 52, right? So this can be higher than the annualized, depending on the numbers. It won't be in this case, but it can be higher. All right, so let me. All right, so it's kind of a tough calculation on the exam, but I'm only giving you 3 months. So you can somewhat manage it. All right. Now, when you do this, you have to give me a footnote. And what this footnote is going to say is there's a rule about annualizing returns. And what the rule is, you cannot annualize returns for any period shorter than a year. So what I want you to do is actually just memorize this. CFA Institute does not allow periods of less than a year. So in this case, we violate that rule because we only have 3 months. That's not a year. So now if you go to the Bloomberg machine and they have a function in Bloomberg, which is a really cool function, it's called COMP. They'll calculate the return, including dividends. And then on the far side, you'll see annualized. They'll annualize it. You know, if it's 2 days, they'll annualize it. So they'll annualize anything. They don't have this footnote. But the rules are, if it's less than a year, if it's 11 months, you can't annualize it. If it's 13 months, you can annualize it. If it's 87 months, you can annualize it. But if it's only 3 months, you cannot annualize it. So Bloomberg does annualize shorter periods. We're annualizing shorter periods. I do want you to put that footnote on your exam because I just want to make sure you're aware of that rule. And you can kind of see that, right? You think about Zoom back in 2020, those first few months when it was up, whatever, you know, you annualize that, you have some massive number because they're up so much over a couple of months. It just doesn't make sense. You need a longer period of time. All right, let's do another one. Now, one thing we'll definitely be doing is I'm going to show you actual exam questions from previous exams so you can see exactly the format. In fact, for the final exam, I will give you last semester's exam and I'll do a YouTube where I work that entire exam. So you'll have a really good practice to do. So you'll see the format. I don't want to get thrown off by the format, but you should be able to switch from one professor's format to another one and still be the answer. There's some students get really confused because the wording's slightly different or how it's set up. You don't want to memorize my format. So that's how it's done because you're going to see it differently. So make sure you're thinking exactly what we're doing so that you can handle it in another context. I'm mentioning Zoom. We could do Zoom, but they don't pay dividends, so I don't want to do Zoom. Let's do Duke. Why would I pick Duke? Well, it's utility. What are utilities famous for doing? Paying really high dividends. Okay, so that should give us some numbers. How do you think Duke Energy is doing? How are utilities doing? This is a good time to be a utility. Maybe so, right? People, energy prices are up. And to me, it's hard to say. A lot of times people say a firm like Valero, wow, Valero must be doing really well. Gasoline prices are up. But what's the negative on Valero? Does Valero produce oil? What do? They buy oil. So what's the negative of Valero? Their cost of goods sold is going up. It's true, their revenue is going up. So I don't know on utilities, it kind of depends. If they produce it, energy prices being higher is probably a good thing for them. If they're acquiring energy from somebody else, like all those countries in Europe that are buying all this liquefied natural gas, it's probably not all that good for their returns, but we'll see. So let's see, there's a dividend. That's a pretty good sized dividend, right? That's almost 1% of their stock price, and that's just 1 month. So paying a pretty decent dividend. If we look at their dividends, yeah, that's a significant dividend, isn't it? This is like almost a 4% dividend yielding stock. Yeah, this is that's a high dividend, right? When the 10-year treasury is at 2%, here's a stock paying you 4%. That's pretty cool. So let's do some returns here and let's see how they did. Let's do December, January, February. All right. Okay, Bill Gates. I'm not sure what Bill Gates wants me to do here. He's trying to figure me out, but he's doing a really bad job of it. So I'll do it for him. So ending market value, beginning market value, dividend. All right, so what's the beginning market value for December 21? See it right there, 97.01. Ending market value for December, no dividends. So ending market value 104.79. I'm sorry. Oh, did I miss it by day? Is that right? 104.90. No dividend. How did I do December 2021? Looks pretty good to me. Ending market value minus beginning market value plus income divided by beginning market value. Would you be happy with an 8% return in 1 month from utility? A low risk. Now, one thing I'll tell you about utilities, they're high yielding stocks, which mean they do not like high interest rates because they're competing with treasuries. When treasury rates go up, utilities tend to struggle because people buy them as a treasury substitute. So that might be a little negative, right, to the thought that they may be benefiting. We'll see. You can't do that 100% because the environment has so many other things going on. So let's look at January when interest rates are starting to rise a little bit. 105.06. Oops. That look right? 105.06 is January 31st. I didn't see a dividend, I don't think. So no dividend, 105.06. So not much of a January. but you're doing better than your what do we Costco friend, right? You can still brag. Yeah, I mean, I'm at 8% one month. I knew they're going to be up, and January they're flat, so I'm still good. Let's see if you're still bragging in February. So 9.85, 98 cents, and 98.5 cents. How do you pay half a penny? Well, yeah, 10 million shares. It's pretty easy to do. It's not that difficult. I don't know if they have an odd number of shares. I don't know who takes the half cent. Their ending value, 141. That doesn't sound good, but they did pay. It did pay a pretty sizable dividend, but not enough. So ending market value minus beginning market plus the dividend divided by beginning market value. So they lost there. Why did they lose? Is it because their input prices went up with the Russian crisis? Is it because interest rates are up? Who knows? But you will notice utilities do not like, and same thing with REIT stocks, they do not like higher interest rates because people do buy them as a substitute. So let's do some averages. So the arithmetic average is 160. The geometric, I've looked in Excel to see if they have a geometric average function. I have never been able to find it. If they have one, they call it something different that I haven't been able to find. I remember when I started my career, Excel used to not have a median function. Now think about it. You've got 100 numbers. You want to find the median. How do you do that? You don't have a function. You have to just sort it all and you go find the middle number. It was a pain. And when I found the median function, I was like, wow, that's the best day of my life. It saved me a lot of time. So we just take 1 plus each one of those. Raise it to the what? Make sure on the exam, you don't just raise the very last one to the power. You got to raise that entire thing to the power, all right? And what do we raise it to? 1/3, and then don't forget to subtract 1. And it better be less than what? It better be less than 160, and sure enough, it's less than 160. Then we can annualize those. Just multiply by 12. And here, on the exam, you probably want to keep this number to the side so that you can raise it to 1/3 and then to the 12/3, because you're going to need that number twice. And then we'll just raise it to the 12. There you can see that geometric was higher. When you annualize, the geometric can be higher, but not dramatically so. And then you put your footnote. And that's the question in the exam. Everybody should get 100 on this because it's just plug and go. So they did well in December before, I don't know if you went back and look at this with interest rates, it'd be interesting to see the change in the 10-year with each one of these. It is interesting if you could actually take a company. Duke's a pretty, they're not the biggest utility out there, but they're a pretty good size utility. You can go get their monthly returns doing exactly what we're doing here. Actually, you can use that adjusted price. That way you get those dividends in there automatically. You don't have to adjust for them. They're automatically in there. And you can run a regression between their stock price movement and the change in the 10-year treasury, and you might find that there's a negative correlation. When interest rates rise, their stock price falls. So you might look and see. I'm not 100% sure that's the case for Duke, but it's the traditional view. All right, I got 3 minutes. Boy, I wanted to show y'all something arithmetic. All right, so next class, we're going to focus a lot on exam 1, but I also want to show you a couple of things. One, I want to show you why geometric is lower than arithmetic, why standard deviation matters. I think geometric's the better number if you're looking at your historical performance, and you'll see why. I'll show you why. But if you're running a model, like a stochastic model, arithmetic's what you need. It's a better number to need. And the other thing we'll do is we'll look at some companies, since we have Excel, we can easily look at companies for more than just 3 months. We can look at 20 years if we want to. And we'll do some statistics on that, which is far more interesting than 3 months. On the exam, I give you 3 months. On the exam, I would love to give you 20 years and you're on Excel and it's all automated, but we haven't figured out how to give you an exam on Excel, so we can't do that. So investment portfolio is a set of financial assets and commodities that fundamentally are proposed to generate income, interest, dividends. A portfolio consists of precisely anything individual owner wants. Before setting up investment portfolio, first decision would be you want to know when investing, what is the purpose. So there's the why. So you get some example there is mitigate liabilities. We talked about that. Liability-driven investing purposes, investing be able to gain enough assets to cover and match liabilities. Furthermore, it's enough assets in case accident liability or even purpose liability come later in life. The knowledge is a good answer. One thing you want to put in there that she's hinting at, but you want to say definitively is the H word. What's the H word? Horizon, yeah. Time is important here, all right? So somehow you're talking about the liability as implies time, but just explicitly said, all right? So she's adding extra stuff that we talked about that's not in the notes. That's perfectly fine. She's obviously not copying the notes, right? There's no plagiarism here, so she's putting in her own words. The second one I do is when investing is what are you going to invest in, the what. I would explicitly, I'd probably give you full credit in here because you imply them, but do put the 3 questions in there. There's 3 questions. Why are you investing and what can you invest and how are you going to execute? Put that up front and then you get into them. You kind of imply it. The various one investor is starting as small and can grow. All right. So what's the P word she needs here? Parsimonious. R squared. So do put that in there. That's pretty important stuff. That's really key to this is, you know, are you going to have 5 asset classes or 50 asset classes? So you have to somehow figure that out. So you definitely want that in there. Execute. When we start, how do you decide to allocate is the strategies, whether to be doing an investing process yourself, hiring a manager. She gives examples. So yeah, I think it's in there. Maybe the only thing it might be in there. Just saying, don't forget the and let me know, Lauren, if I missed it. The active versus passive. That might be in there. I just didn't see it. But that has one. It's kind of part of the tactical. Yeah. She's covered it really well, but have the active versus passive in there. Now she gets in the major asset classes. So first is cash and cash equivalents. Now she doesn't specifically list the 4 asset classes, the major asset classes. I would start with that. If she doesn't do that, but they're there, like she introduces them by introducing them, you know, she does bonds and does all the bond stuff. I'll give her full credit because she talks about that. Because she says first, second is bonds. So I would give her full credit, but you know, it's probably good just to say them 4 major asset classes are cash, bonds, stocks, and alternatives. And then she starts with cash. She gives examples. That's good. She talks about its characteristics. So one big thing here is the cash. I hate cap locks. Cash versus bonds. We want to talk about the reinvestment risk versus price risk. All right, that's one whole thing in mind. So remember what we said, you know, cash and bonds are the same thing. You're just loaning money to somebody. So why do we make that distinction? It has to do with these 2 risks. Cash has what? Very high what and very low what? But very high, very low price risk, almost non-existent. You don't notice the price of your savings account moving up and down. And so it has very high reinvestment risk. It's very sensitive to interest rates. If interest rates fall, your income comes down. That's not true at the 30-year treasury, right? You buy a 30-year treasury, you're paying you 5%. What happens when interest rates fall? You still get your 5%, no reinvestment risk whatsoever. All right. And price risk is interest rates rise, prices fall, but cash doesn't really happen. Cash really just stays at the same way. All right. So yeah, so make sure, Lauren, you have that in your answer. Otherwise, it's kind of confusing. We're talking about cash, now we're talking about bonds. Well, they're the same thing. So it's like, why we're making this distinction is bonds. She gives a definition of bonds, which is actually, oh, you did that, Lauren. You should have told me it was coming up.
Oh.
So,
Completely forgot. I wrote this like a week ago.
okay. Oh, you got a lot in here. So let's see. So she has it in, I don't see specifically price and risk and reinvestment risk. So have those phrases in there and define them. All right. All right. Now she's getting a sub asset. So actually this was her main asset classes up here. She's just doing more discussion, which is fine. Did you see it? I could probably do a search and. Well, you have to say what you mean by low risk. They have low price risk, but they have high reinvestment risk. But we usually think of them as low risk, because most of us think as risk is price risk. But reinvestment risk, like I talked about the guy who had all those CDs and he was bragging in 2008, and then suddenly his CDs were making him 80% less. Yeah, the price of his CDs involved, but when your income falls 80%, I would consider that kind of risky if I'm a retired person, So, okay, bonds, we'll discuss duration and maturity. Duration is a way to comparing bonds for like their likeliness change when interest rates might go up or down. You can put the actual definition duration. It's the weighted average time to maturity using discounted cash flows. That's the way I would know that. We're actually going to calculate it when we value bonds because it's a pretty easy number to calculate. I don't count off our spelling, but I guess that's a word. I don't know why Bill Gates isn't catching that one for you. So I'm not sure what you mean here, but you might compare papers to each other. So what we're saying, so you want to specifically say how many subclasses do we have on duration? 2, 3, 4, 3. And what were they? Short term, intermediate, and long term. So short term has low duration and low price risk. Long term has high duration and high price risk. You want to specifically say that. I'm not real sure on interest rates is short, but you want to define it. So you got the 3 categories. So define duration, the 3 categories, and then let's see. Yeah, so you got to specifically say, I'm trying to find it here. This is hard to do this in front of right. Yeah, so she's using the formula. You should put the formula in here, that minus duration times the change in yields. I would definitely put that formula. She doesn't specifically have the formula, but she has enough that you can tell what it is. Interest rates increase 1%. Bond has a duration of 10 years. It's going to fall 10%. She has that in there. So she needs to specifically talk strategy. That's really, really important. And remember the words. It's not, you don't say when interest rates rise, you shorten duration because that's too late. So what do you say instead? When you expect interest rates to rise, you shorten duration. When you expect interest rates to fall, you lengthen duration. So convexity, she's got the definition. She's talking about embedded options. She talks about mortgage-backed securities specifically. A very low convexity. Right, so again, strategy. And she's got the types somewhere in there. She's got non-callable and she's got mortgage-backed. She's got the 2 asset classes. She's defined it fairly well here with the strategy. So that's one thing, learn strategy throughout. You expect what here? Interest rates to get more volatile. What do? By convexity, by callable, non-callable bonds, you expect interest rates to become more volatile, less volatile than mortgage backs would be a good place to go because you get that higher starting yield and you'll get to keep it because rates aren't changing. Credit is ability to pay. There's risk of paying. So here again, the categories, high quality, medium quality, to low quality, including, junk bonds. Don't forget on here, two things on credit. One is there's also the sector aspect of it. Energy was a big deal and retail was a big deal because of COVID. Energy is coming back, growing back now. But what sector you want to be in? Obviously, retail with hotels and airlines and those kind of things. That, I don't know if any of you are taking the fixed income class, but they've been talking about airline bonds with COVID and everything like that, kind of risky sector to be in. Think about the sector. And then again, the strategy, like we said. And on this strategy, it's a little tougher because if you're expecting a recession, you're expecting two things. You expect spreads to do what in a recession? Widen. And what else do you expect in a recession? The real interest rate is going to probably do what? It's probably going to fall. All right. So in a recession, you expect rates to fall, unless you're Russia. But in normal times, you expect a recession, interest rates should fall. So you expect spreads to gap out, widen, you expect rates to fall. So you want to go up on quality and go out on duration. If I knew for sure we're having a recession next year, probably what would I probably buy? Probably go out and buy a bunch of 30-year treasuries, right? Unless someone told me recession next year, but with a lot of inflation, that might make me a little nervous. But yeah, if it's going to be a normal recession, I would most likely buy long treasuries. All right. US versus non-US. Currency affects bond. When you decide to invest, you're taking a risk to lose your money with the US. Currency risk is highly monitored. Inflation, interest rates. Yeah, that's essentially what I want. I mean, there's not many subcategories here. It's either US or non-US. Then she talks about taxes. Say one thing here, Lauren, I would definitely do is put in the formula. The tax equivalent yield, put that formula in, all right? And then just say you're picking between corporates and municipals. The structure bond depends on the way top rate. Yeah, I think she's got that one pretty good. Yeah, structured, structured is huge. It's a big chunk of the Fibonacci book, but we're just scratching the surface. I don't know what John's doing in his fixed income class. You could spend the entire semester on just one subcategory of structured debt very, very easily. It's a huge amount going on there. Inflation has a major effect on nominal bonds because their prices depend on how low or high inflation is. The inflation-linked bonds are designed to protect. They also produce a payout that increases or decreases inflation. You might specifically say principal adjusted annually for CPI. That might be something put in there specifically. And I would say we're talking about tips, right? As far as I know, only the US government has US bonds that are inflation tied. I don't think any corporation, there's maybe a couple corporation out there that's paying an inflation linked bond, but it's for the most part, it's US government, they're tips. All right, so here, Lauren, what do we miss here? So you went right into beta risk. What might you put before beta risk? So this is the intro, right? So don't leave out the intro. So Lauren, that's actually one of the biggest things students leave out is that intro. So what is a stock? Before you get into beta, what is a stock? What's the expected return on stocks, dividend yield plus earnings growth? And then earnings growth is always closely tied to economic growth, productivity, labor growth, inflation. That's what I'm looking for, okay? So don't leave out that intro. Beta, low beta, high beta. You want to specifically have the words cyclical and defensive in there as well. So when you say low beta, also known as defensive, high beta, also known as cyclical, have those in there. She gives examples, exactly what you want to do. Here's an example of a high beta. Here's an example of a low beta. Now she gives actual stocks, which is, even more interesting. I'm generally thinking, consumer discretionary is high beta, consumer staples, but she's giving actual companies, that's fine. Capitalization, large cap, mid cap, small cap. Yeah, you can leave out the micro cap and the penny stocks. They're not, not much to them. And yeah, and the cap, you can put it in there. Just remember that changes all the time. There's not why we don't really know where large cap starts and mid cap starts, and they overlap, and it's a bunch of debate. And it really comes down to round numbers. So how do you figure out large cap in the Russell 3000? Russell 1000 is large cap, Russell 2000 is small cap. How do you think we figure out the large cap? We go down 1,000 stocks and we stop. So wherever 1,000 is, that's the end of a large cap, and wherever 1,001 is. It's not quite that way because they do have some industries they try to match, but it really is. They get their 1,000 stocks, and once they get their 1,000 stocks, the smallest one is the smallest one. That might be 20 billion, might be 40 billion, depends on what the stock market's doing. All right. All right. So again, strategy. The nice thing about the strategy for stocks is it's all about recession or growth. So that makes it really easy. You're expecting recession. Let's go through it. Beta, what do you do on recession with beta? High beta or low beta? You expect a recession, low beta, defensive. Capitalization, expected recession, large cap or small cap? Move up in cap, move out of stocks overall, but move in cap. All right, so have that in your strategy. It's pretty straightforward. Style, whether they're growth or value growth, stocks those have high potential growth, high valuation, value stocks, a company trading lower price and strong growth potential. Can have, I mean, this is not really part of the definition. So that's kind of, you're saying it's possible, but it's really not. I mean, they're really not expected to grow in the future. That's why they're value stocks. I like for y'all, I don't count off what's this, but I just think it's really important. Just always remember value stocks are low quality companies, because that's so confusing. People hear value and think, oh, that's high quality. Value stocks are low quality. Something bad has happened to them, because that's going to help you when you talk about the strategy. You're expecting a recession. What are you going to do with value stocks? You probably don't want them, because they're already having problems. If they're already having problems, then if the economy goes in recession, they're probably going to be crashing. And then U.S. versus non-U.S., less risky emerging frontier. You might give a little bit more definition of what each of these are. See, emerging markets tend to have higher risk. If you expect to grow and faster growth, that's all good to do. One thing to put here is some comment on currencies. All right, you might have, and I didn't catch it, but some comment on currency. Not as big here as it was on the bonds, but it's still important. For bonds, currencies take over everything. For stocks, it actually becomes part of the asset class itself. Alternatives. All right, one thing before alternatives. You need the intro here. So she's got this. She's only missing, let's see if she may not have missed it. All right, so on alternatives, let me help you, because the notes, I didn't do a great job on the notes. She's got the diversification part, so I would say its purpose, it adds diversification, and for real assets, what do we get? Some inflation protection. All right. And then what are our real assets? Real estate, timber, commodities, other specialized. All right, so keep it organized like that. So real assets provide inflation protection. Real assets are real estate, timber, commodities, and the others. I don't know if the others really help with inflation all that much. All right. So she's got the diversification. I would, just maybe have an introduction. Alternatives, everything else. For our purposes, we're going to break it between real assets and private equity. Real assets, Alternatives provide diversification of portfolio, and specifically real assets also generally provide inflation protection. You get that introduction going, and then you say real assets. First, I'm going to start with real assets. So she has that. First, I will mention real tangible assets, and then she starts off with real estate. So she'd probably get her credit for the inflation because she talks about inflation there with the real estate. So she has it in there. It just might fit better in the intro. Timber. You might add the store on the stump. Y'all remember that? Timber is a very unique asset class in that it's both real estate and a commodity all mixed together. And if you don't like the commodity, you can just let it sit there and you get more commodity just by letting it sit there. That's kind of nice. And if you don't like the commodity, really don't like the commodity, you can sell it as real estate. I mean, it's a very flexible asset class. I would on your answers, break it up more, all right? So don't have your paragraphs be too long. Partly, it, helps you with your answers so you can see what's there, but also really saves me time and grading. If I have a paper like this, probably what I'll do is I'll load it in Word so I can actually add paragraphs so I can grade it easily. So you save me time so I can just grade it in Blackboard and I don't have to load the file. So that would help me. So yeah, break it up. You can even use bolding. Bolding again helps me, but it also helps you to make sure you didn't leave something out. She talks commodities. All right, so on the inflation, she only mentioned inflation on the real estate. So if you put it in introduction, you've got that covered. You don't have to keep repeating the diversification because that just goes into introduction. So on the commodities, I would mention the categories: energy, agriculture, metals. I would have those categories. All right. You don't have to go much further than that, but talk about those categories. And then the last one, venture capital, private equity, high risk, high return. And the only thing to add here is the J curve. Talk about the J curve. It's a cash outflow up front, but then 7, 8, 9 years later, it comes back. And there's a good article. There's some people who really get mad at private equity because they're going to do a $500 million fund and you're going to give 50 million of that. So you send them the $50 million and they start charging you this big fee, but they haven't done anything with your 50 million. Your 50 million is just sitting there in cash and they're charging you 2%. And they're like, okay, why don't you start charging the 2% once you get it invested? And before that, don't charge me anything. So there are firms out there saying, yeah, you can send us some money. We won't charge you anything until we get it going. So that's a good draft, Lauren. Thanks for volunteering. Yeah, she's got a few things she can clean up, but she's got a week to do it. So she's not that far off at all. She's got a lot that she can add. Any questions about the stuff I said for her to add in here? Do y'all want to see the killer answer from last semester? Not yes. All right. Well, I got to go find it. It is open book, that question. The second question is not open book. So make sure you know that. I hate all these pop-ups that come up every time I do something. I hate to show this to you because it's gonna be, he really went overboard. I mean, Lauren, a few places, she added extra stuff. I love that. I mean, it may not get you extra credit, but who cares? You're not doing this for the grade. You're doing this for the, sorry, for some reason it wants, I don't know why. Okay, just a second. Sorry, this is good old Bill Gates or whoever, someone's. I did tell him I was going to do this, so he was okay with it. All right. Just a second. Yeah, I don't know why it's doing that to me. It's very frustrating. It will not let me into sorry. I don't know why I can't go into PDF without. Now they have to send me something on my phone, of course. All right. This was a simple thing, wasn't it? I was just going to show you real quick. 3 weeks later. All right. So what is an investment portfolio? 3 questions: why, what, how. See how he's doing me a huge favor? Is he's boldly showing me exactly what he's doing. Why are they investing? In order to determine their investment goals without a clear defined reason. Investment. The most common goal for investment portfolio is liability driven. Lauren had a lot of that in there as well. The portfolio thus acts as a conduit for future cash needed. To solve some examples: liability, retirement, pension. One has to understand the reason for investing, the time frame. He's got the time frame, and thus the investments made in a portfolio ought to properly reflect portfolio's horizon. He's got that. He's still on the why. Without understanding one's horizon, you're going to very difficult to create an investment portfolio. One must also account for changes in inflation. The way he's getting into it. The horizon is crucial because it also helps determine diversification strategy. So he's going to really go into it. Then he gets to the why. He's on the second page. The first page was 100% on the why. All right. The asset allocation are the asset classes one chooses to include in a portfolio. Through asset allocation, one can determine what markets they ought to invest. One ought to make parsimonious decisions. They also should not have an asset class strategy with too little asset classes. Talks about the R squared. If one chooses 5, he goes into the example I gave. 5, you get an R squared of this. 10, you get a 1 of this. He uses that exact example. So he goes through all of that. The ultimate key to remaining parsimonious is by ensuring that the asset classes are diverse when it comes to their expected return, expected volatility, and expected correlation. So he gives that. Then the how: one should choose to execute the portfolio. They answer the few questions. What is your strategic allocation? A policy portfolio: should you hire a manager? We try to be tactical. He goes through each one of those. Answer whether or not you should hire a manager heavily depends on the asset classes one is considering. One we're saying once, it goes a lot of detail. Some of this we talked about, but it's not necessarily in the notes. For retail investors, it may be wise to hire a manager to manage the entire portfolio because of the investor's lack of knowledge. When we try to be tactical, we're trying to beat the market. When one is trying to beat the market, one must inherently believe the market is wrong to an extent. I mean, he's putting stuff in, extra stuff in, which is, I love. I don't have any problem with that at all. I can't read this whole thing to you because it's just, we take the whole class. Here he talks about the active versus passive. Active investment means one is trying to pick specific stocks that beat the market. Thus, active investors will face similar challenges that tactical investors face. Passive investing, he actually gets into EMH. That's a little overkill for this paper because we covered that well after we finished, but he got into that as well. The asset classes: cash and cash equivalents. He's got the reinvestment risk in there. He's got the price risk in there. He's got examples. Cash versus bonds. He talks about it again. Bonds will have less reinvestment risk than cash. Now remember on bonds, don't say bonds have low reinvestment risk and high price risk. That's just not true. Cash has high reinvestment risk and low price risk, but bonds have varying degrees of reinvestment and price risk. Long-term bonds have high price risk, low reinvestment risk. Short-term bonds have higher reinvestment risk, but lower price risk. So it varies. Cash is just no price risk, all reinvestment risk. So, all right, so y'all see I can't really do this. Then he goes bonds, duration. The weighted average time takes to reach maturity using the discounted cash flows. He has the formula in there. If interest rates decrease, a good tactical decision will increase the allocation of bonds to higher duration bonds. He talks about the strategy. Convexity duration is the first order duration, and convexity is the second order. Convexity highlights the bond's sensitivity to volatility. Some bonds have embedded options, callable bonds or bonds. He goes into that in detail. Mortgage-backed considered securities. He talks about the actual negative convexity and what that means because of refinancing. They're far more sensitive to interest rate volatility. They have negative convexity. Credit is the firm's ability to be solvent. There are categories of bonds. He's got the categories. I don't even know what he all said in here. When a recession occurs, the risk-free rate will fall. When the economy improves, spreads will narrow because of the risks. Solvency decreases. There are also general rules of thumb when the economy is stagnating with inflation. And he gets really into it. He decided to take that matrix I put in the notes and fully define it in this paper. That's a little overkill, but I don't mind. I prefer overkill to underkill. And isn't that true, right? Would you rather see an animal riding in the street that got clipped by a car, or just it was done, you know, overkill, overdo it, kill it, crush it. All right. It's not a real beautiful image, but maybe that would give you something to think about while you're preparing for your answer. US versus non-US. He goes into PPP and the CPI, and he does a lot of extra there. Currency risk present in non-US bonds helps add diversification. That's true, but it adds a lot of risk. Municipal bonds are tax-free, tax equivalent yield. He gives that formula. There's the formula there. He talks about the strategy, financial structure. He gives here. He really went overboard. Why did he do that? Was it for the grade? At this point, he already knows his grade. Right? He's already decided I'm going to ace this exam. Why did he do this? Because he's a finance major and he want to know this stuff. Kind of a novel idea, right? I want to know more than anybody else out there. And so he went on, he went into CDOs, he went to POs and IOs. So he decided, and I was like, my word, what? I mean, this is more John Dewey's class, you know, the next stage. He's kind of getting ahead of himself. Inflation, he talks about tips. Stocks, let's see if he gets the introduction. While a bondholder loans money, a stockholder is purchases a claim of ownership. Stock's investment value, the business lesses those claims. The firm goes under, the stockholder will not receive anything. In the United States, they have limited liability. He talks about that. A lot of students do put that in their paper. That's not overdone at all. One of the most basic, most important equations is the expected return on stocks is the dividend yield plus expected earnings. He has repricing in there. You can leave that in or not, but we kind of somewhat ignore that. When determining expected return on stocks repurchase becomes, well, he put repurchase. Yeah, we're going to do that on paper 3. He decided to put it on the exam 1 before he even covered it. He decided to go ahead, went all the way back to 1871. Yeah, he's still talking about stock repurchases. That doesn't belong in this paper. He talks about earnings being tied to the economy. So you got productivity, he's got labor and inflation. Then he gets into beta, cyclical company, defensive company. If one expects the economy, he's got the strategy in there. He's got US versus non-US. So he made, you know, it's pretty good. I think he made a 72 on this. So, no, he didn't make it. I can't keep going. I mean, he decided, forget grades, I'm just going to learn. I love that. I think that's a great attitude. He's not a student that came to me and say, how many pages should this be? He's kind of saying, says, hey, do you mind if I make it 50 pages? And it's like something, it's like, can I get away with 1 paragraph? No, you can't get away. It's gonna. Now, I did have a paper this semester that was essentially 2 paragraphs in 1 page. So y'all see kind of my life, right? I grade this paper and the next paper is 2 paragraphs on 1 page. And the second was like, how did I get such a low score? And I'd love to sit down with her and show both papers. Not that this is the right answer. This is definitely too much. I don't mind too much, but you don't have to do that. That's a pretty intimidating paper. But I mean, you're competing against the world, aren't you? You got all these finance majors from all over the world competing with you. Which of those two people would you hire in your firm? This guy or the 2 paragraphs in 1 page? That person might know as much as he does, but I have no evidence for that. All I have is what he submits. So when people call me and say, hey, Ron, and I just got an email, probably got 2 emails this week. Ron, I need some names for jobs. Guess which person I'm gonna send them? This one I'm pretty sure is gonna not disappoint if they hire them. The other person, maybe or maybe not, I don't know, but all they gave me was 2 paragraphs. So, so go for it. Yeah, it might take you an extra hour, but all right. Any more questions on the exam? Not that I've freaked you out with
Yes,
that.
I'm confused. Are we supposed to write these down and the daily exam we just present?
No, you can do it today and submit it. I'll have it up there on Blackboard. Yeah, it's open book. You submit it in advance, typed. Yeah.
When you're saying that the second question is not going to be are we doing the second question?
Second question here at class. First 30 minutes. After you finish it, we'll have class afterwards.
The second question is pretty much like the examples that we went through, right?
Well, this is the second question from last semester. This is the second question from last semester. You'll have a different one. The one I put out on Blackboard, this is the actual question from last semester. I hand this out with a couple of pieces of blank piece of paper and you have 30 minutes. You don't have 35 minutes, you have 30 minutes. If you finish in 20, that's fine, but you have to watch your time. So any other questions? Are clear? I'll put the first question out there when I put it on Blackboard, but you already know what it is. I remember one semester, we were doing the first question in class, and one student who had never been to class, he walks in and he goes, what do you mean by the 3 questions? I was like, I can't answer that. He had no clue. So I was like, yeah, I don't think that's gonna go well. He was the only one in the room. Everybody else was like, didn't even look at the question. They were already writing. Because they knew what I was asking, but he had missed so many classes, he had no clue. All right, so did anybody answer this yet? Let's try it. All right, well, let's go for it. Y'all tell me. So remember, the most important thing you're trying to do is economy. That tells you everything you need for stocks. You want to look at rates, interest rates. That's going to tell you what to do on duration. It's going to tell you what to do on convexity. If rates are rising, falling, more volatile, less volatile. Something on inflation. That's going to tell you about tips, might tell you about real assets. That would be important. You want to look at the US dollar. That's going to help you some on US versus non-US stocks, because I'm not going to give you US, non-US bonds. That's essentially it, isn't it? I mean, you get those pieces. So if you look for those, let's see. So your boss has just provided you, again, this is not my forecast. This is my pretend forecast. So I don't even know if I agreed with this one or not. While the economy looked promising at the start of 2021, several factors will impede the return to normalcy, which now appears much further away than anticipated when the vaccines first became available. So how are we looking so far? Are we positive or negative on the economy? How does that sound?
Something negative.
That sounds pretty negative, doesn't it? Consumer sentiment is beginning to weaken, yet companies are struggling to find workers and higher inflationary numbers refuse to abate. The recent much weaker than expected jobs report point to a downward shift in economic activity, but the inflationary pressures will limit how aggressive the Fed can we're saying at least concern here. We'll see if the negative economy is going to make them changes and say, yeah, inflation's an issue, but it's actually become a non-issue because the economy is going to slow down. But we've got some hints there. I believe economic growth for 22, 23 will be much lower than currently priced in markets and outright recession. So is that negative or very negative or slightly negative? That seems pretty negative, right? You already have an idea how you're gonna invest, don't you? Are you gonna be buying a whole bunch of small cap value stocks in this environment? Why wouldn't you buy a bunch of small cap value stocks? There's three reasons. First of all, so weak economy, so small cap, you prefer large cap. But first of all, there's stocks. What are you gonna do with stocks? Underweight stocks, and then within stocks, what are you gonna do with small cap? Underweight, you'd rather have large cap, and then what are you gonna do with value stocks? Underweight, because they're weaker. So you already just, with what we just read there, we already have a pretty good idea what we're gonna do on all the stocks, except for the non-US. The Federal Reserve will have no choice but to scale back on its balance sheet, undoing much of the quantitative easing, and they might still have to raise short-term rates a couple of times, though as successfully low. I think they will win the battle against inflation, as inflation will drop below expectations. So now what do we say? Concern, but will fall back. All right, so some students mess up on this question because they saw the early thing where I said inflation is an issue, and they're like, they've already got that, and they didn't read that part to offset that. So be careful on that. All right, so looks like inflation is probably not a concern. So we'll drop below expectations. So if inflation is going to be below expectations, I sure don't want to buy tips, because what are tips pricing? Inflation. And so you're going to get a real yield plus inflation. And if inflation is going to be lower than that, you're going to end up getting a lower return. So you would not buy tips in that. Longer term interest rates will actually fall. So what are rates going to do? Short term rise, long term fall. All right, that's pretty important. Given their already low levels, I do not expect them to fall dramatically. Interest rates should be less volatile than we've seen in a while. So fall slightly with low volatility. Got a lot of stuff already. You could probably, off the top of your head, give someone investment advice based on this without my list of asset classes, couldn't you? You could have a pretty intelligent sounding answer, I would think. Corporate earnings will start to disappoint after quarters of impressive beats, and corporate and municipal bond spreads should widen. So spreads are going to widen. So what are you going to do with high yield? Probably underway, almost avoid them, right? This is not the environment for high yield. Don't forget the high yield are low quality bonds. Some students get a little confused on high yield. High yield is low quality bonds. I could put them, instead of high yield, I could call them junk bonds. That might make it a little easier. The global supply shock will impact countries very differently. Export-led emerging countries will be especially hard hit and see very weak economic output. Emerging markets the worst. Let's see how Europe is going to do versus the US. The US, while weak, should fare slightly better than other developed economies, and the US dollar will strengthen. All right. US best. Dollar strengthen. I think we've almost got everything we need, other than a tax rate. I think we were there. U.S. while weak, okay, with the U.S. Federal Reserve being one of the few major central banks seriously contemplating raising rates. So yeah, the dollar should, and we've seen that, haven't we? The dollar is going to hold up well with the Fed's raising rates, and everybody else is still shell shocked. I am much more positive on commodities. I believe the chronic underinvesting the past several years has placed us in a strong upward cycle for commodities, and we should see prices continue to. So that was a gimme. Commodities strong. So what would be your recommendation on commodities? Overweight. All right. There's students that miss that. That's how stressed y'all get in exams. It's like you're so stressed on the hard stuff, you forget to write the easy stuff down. Don't miss the easy stuff.
So how many bullets in for commodities?
Well, that's the one that's unknown. On alternatives, remember, everything else is obvious. Treasuries, there's 2. Tips, there's 1. Mortgage backs, there's 1. But on commodities, it kind of depends on what information they give you. So this one, they've given you mixed information. We usually say we like commodities when inflation's an issue, but they just said inflation's not an issue. But they told you commodity prices going up. So which of those is more important, an inflation one or commodity prices are going up if you're trying to decide on commodities? To me, the fact that we think prices are going up is far more important. Can commodity prices go up and inflation not go up? Well, it's a little tricky because commodity prices going up causes inflation. But if there's other things, on the other side, they're saying commodity prices aren't going up because the economy is strong and prices are rising. They're going up because there's been so much underinvestment. There's undersupply, so their prices are going up because the supply is not big enough for demand. So assume a marginal tax rate of 40%, an effective rate of 34%. All we need is the 40. So I've given you all that stuff, but that's right there is all you need. That's everything you need. Weak economy. Emerging markets can do the worst. The US, while weak, is going to do the best. Interest rates, short-term rates will rise, but long-term rates will fall slightly, but with low volatility, but spreads are going to widen. Inflation is a concern currently, but it's going to actually come in lower than expected. The US dollar is going to strengthen. Commodity prices are going to be strong, and the tax rate is 40%. There's nothing we need other than that one thing. So we get in here. I'll just answer it because we're running out of time. So long-term treasuries, okay, recession. So overweight has long quality, falling rates, overweight, duration. How many things in the treasuries? 2 things. Did I mention them both? One about the economy and one about rates. All right. How do you get 50% on this? Overweight as expect recession. Now, granted, recession means you want more quality and rates are going to fall, but you didn't say that. I don't know that interest rates generally fall in a recession, so that doesn't give me enough. So make sure on your answer you put 2 bullets. Okay. Bullet 1, bullet 2, and then make sure in each bullet you mention recession, you mention interest rates. All right, make it as explicit as you possibly can. Everybody get that? That's real important. There's students that really struggle on this. Be absolutely. The reason I'm picky on that is that when you get into an interview, you want to be that explicit. All right. Hey, we're expecting a recession. Boy, I'm going to move up in quality and buy some treasuries, and usually interest rates fall, so I'm going to be going to longer term treasuries. So I actually gave you 2 asset classes here. I gave you long-term bonds and I gave you treasury bonds, and you got to talk about both of them. Long-term bonds like the rates falling, treasuries like the fact that it's recession, so you want the higher quality. Inflation linked, probably underweight as inflation below expected. That one's pretty easy. Mortgage backed, what do y'all say here? Overweight. Now, if that's what you say on the exam, you get 0 points. It's the right answer, but you get 0 points. And why do you get 0 points? You have to say why. All right. This is not a true false. I hate true false exam. I mean, it's 50-50. You should get a 50. Someone takes true false and they get a 30% score. There's something, bad luck going on there. Overweight as expect rates less volatile. You have to put one last thing on there. So you want to do what? Capture what? Your higher starting yield. Right? Why do you get a higher starting yield? Well, to pay for the negative convexity. When do you get to keep that higher yield? When interest rates are stable. All right, here, remember on the municipals and corporates, well, how many bullets under them? 1, 2, 3, 4. So here you have 3 bullets. So what do we have here? We have medium quality. There's one thing. What else do we have? Short term, that's two things. And what's the last thing we have? Municipals versus corporates. Okay, so if I were you, I'd say medium quality, underweight, or higher quality session. All right. You can see it doesn't have to be a paragraph. Like I should show you the other guy's paper that his answer here, he kept it fairly short. Short term for longer term as longer rates falling. Right? I don't really want short term. Short rates are rising. That doesn't mean it's a disaster for short term because of how much duration, but still, if you have a short term bond and its rates rise, it will lose a little bit in price. So there is some loss there. So I'd rather have long term bonds where I get the higher starting yield and rates are falling, so I get some price. And in corporates versus munis, I take the 0.0215 divided by 1 minus 0.6, and I get whatever that is, 215.16, 358. So prefer munis over corporates. Now, granted, we're going to underweight these, so I'll underweight corporates more if you want to say something like that, right? I prefer munis over corporates, so when I underweight these, I'll underweight the corporates more because the munis have a tax effective yield of 358. Compare that to the corporates of 250. I'd much rather have that. Yeah, I'm sharing or not? Yeah, I'm sharing now. Okay, that's from earlier. All right, so three things under corporates, and you don't have to break them into separate ones. You can say, if you want to on your answer, say for the munis and the corporates, bullet, bullet, bullet. You can do it like that. So I know you're talking about the two of them together because there's no reason to say for munis medium quality, I want to do this. For corporate medium quality, you're going to say the same thing. So there's no reason to break that up. High yield bonds, only one thing here. Underweight, I would even say avoid, expect recession. That would be full credit if you say that. You don't have to say, these are low quality, I prefer higher quality. And then what's the bullet that's missing? Stocks overall. Underweight, expect recession. Bonds. So that one you just have to put in there because it's not there. I might even start with that one. US large cap growth, there's two things here. Well, it's three things, but there's really two things here. Large cap and growth. So what do you start with those first two words? Within stocks, overweight, because we may actually underweight large cap, but we may underweight them 5% and we may underweight the others 10%. So within stocks, we're going to overweight large cap as expect recession. And if here I'd be really explicit, if I give you small cap or middle cap versus small cap as expect recession. So make it really clear you overweight large cap over the other stock type, over the small and mid cap. And then within stocks, overweight growth as growth. It's better session. Small cap. Now in small cap, if you're real explicit on the large cap, overweight large cap versus small cap as expected recession, I'll give you full credit for both places. If you're not explicit, then you got to say it. But within, well, here you don't have to say within stock because you're underweighting, but underweight small cap versus large cap as expect recession, and underweight cyclical stocks as expect session. So just make it really, really explicit. Develop marketing, by remember on that one?
US is doing better.
Yeah, US is doing better, so underweight as US economy expected to do better. Europe. And the second thing is, what's the second one? You expect what? Strong dollar, right? So you have the currency aspect in there. You expect a strong dollar. Emerging market, this one's easy, underweight as economies worse. I know how you spell fair. And then alternatives. The only alternatives they talk about are commodities. If you want to talk about any in particular, we can certainly entertain that. And gold, what do you think about gold? Strong US dollar, not much inflation. So that doesn't sound like a good asset, does it? Gold in this scenario doesn't sound all that good. So, but they didn't mention gold, they mentioned commodities. So I would definitely overweight commodities, and that one's easy, as expect strong price movement. So that's pretty obvious. But if you want to add some other things, you could. So you could certainly talk about gold and not being a good one here. Private equity, you know, there's not much to work with on private equity here. I don't think private equity would do particularly well in this environment. It's not going to look as volatile because it's, you know, you don't have daily price, but it's probably not. What? For private equity, yeah. Yeah, I mean, this is kind of a, this is kind of your creative side. You know, you could say, we don't expect inflation. Some real assets like real estate probably not well recession, low inflation. I mean, that would be true, right? There's not a good case here for gold. There's not a good case here for real estate. But she didn't mention gold. She didn't mention real estate. All she talked about was commodities. But if you want to bring some of these others in, that's perfectly fine. If just make sure it works. Don't say avoid private equity because of inflation, unless, I mean, that one you're going to have to write an extra 20 pages because you're going to have to explain that link. Right. So if you're not sure about it, I wouldn't bring it up. If you're pretty confident, gold's one that works pretty well because you know gold loves weak US dollars and high inflation. And this scenario is the opposite of that. So you could certainly bring that in. All right, so this would probably be 100. This is a tough question for some students because it's not multiple choice. You really have to sit down and think, what do you know? There's absolutely nothing in this answer that's not on question one. So if you understood question one, you just apply it here. So it's not like it's two questions, it's really one question. So you'll get this question without the answers and blank piece of paper, and you'll just start writing for 30 minutes. And it shouldn't really take 30 minutes. I don't think it took me but like 10 minutes to do it. So it's not a lengthy questions. Questions on that? Can y'all do this? Yeah, you can. That's what most people do, yeah. What most do is they tend to, you know, healthy long-term treasury, something like that. And just keep it shorthand, tips, MBS, MQ, ST, munis, you don't have to write it all out again. I guess I could put that format there for you so you could, put spaces there. Maybe that would help you if I did that. Maybe I'll do that. I don't know if I remember. But this is out on Blackboard, so you have it. I love this question because if you understand this question, you will do very well in interviews. This is, and I don't think many undergraduate students can actually do this. I think if you went to other schools and asked, talk to finance majors, I don't think they would. I know you, Michael, you see it in your job every day, so you're kind of used to that. But a lot of students, it's like actually applying it. Hey, I know something. What does it mean? It's really tough. So this is, I know the grades there, but who cares about grades? This is, are you actually understanding this stuff, which is far, far more important. And if you do, boy, you're gonna do extremely well in interviews. So. All right, so I'll stop on that. Hear any more questions? If you have questions, you can certainly, call me. I've had a couple people email me their answer and say, can you check over it? If you do that, well, I'm going to give you extremely high level. I've got, boy, I think I have 70 something papers to grade this weekend. And I got to get those graded. So I'm pretty busy, which means I don't have time to type a long email back to you. So if you really want to get into it, you're better off emailing it to me and setting up a time and we'll go through it. If I don't have to type my response to you, I can do it much, much faster. So you talk to each other, just make sure your answer is your answer. All right. I am going to be checking, plagiarism on this. So make sure it's your answer. I think there's actually some answers to this question probably out on the internet somewhere. I've discovered papers from my classes out there. But you can't turn those in because it's gonna find those. So write your own independent stuff. All right, we're talking return calculations last time. I want to show you, this is, get rid of this guy if I can. This is Choice Hotels. I was telling you about them. Oops. So Choice Hotels, on August 24th, 2012, this stock that was trading for $40 paid it went X on a $10 dividend. That's pretty radical. I can't think of too many examples that are quite that extreme. Now, why did they do it? Well, because I think it was a really bad decision, but Congress was talking about changing some tax laws. And so their thought was, wow, capital gains, dividends are going to be taxed at a much higher rate next year than this year. Let's go ahead and pay all it out now. And then they'll pay tax on a much lower rate. And then next year they don't have to worry it. But the tax rate didn't change. So what did they do? They just caused tremendous amount of tax liability for their investors, which they probably didn't care for that at all. We had a similar discussion, I know, at USAA about maybe doing higher capital gain distributions than normal, but we decided not to do it because who really knows? If you do it and the tax law changes, your customers don't really thank you for that because they don't really know you did anything. If you do it, a tax law doesn't change, then they're really mad at you because they pay more in tax. So you don't get any upside and you get all the downside. So I don't think that was a very wise decision to do. But do you notice it? Look at the close. The close went from 43 to 31. And we own this stock. And so I'm panicking, like, what in the world happened to Choice Hotels? Did they announce something? But was there any reason to panic? Things are perfectly fine. So how much did it fall? 1167 or something? It did fall more, and you can tell, look at the adjusted close. What is the adjusted close doing? They're adjusting these prior numbers for that dividend. So the stock did fall from 29 to 28, or essentially fell about $1. And that fall tells you percentage change. So it did have a bad day, but it didn't have that bad of a day. It didn't fall 25%. This isn't Facebook. It didn't fall that much, but it did fall, 3-4%. So X date, this is X date. Now, what if it went X date in August, but they did payment date in January? Then they'd really mess up because the tax, when you pay the tax, is it on X date or payment date? That's definitely payment date, right? So that would have been a huge mistake. So I'm assuming they paid it in September or October. That's a lot of money. I mean, think about that. Most firms trade at a price to book of like 2 to 1. If you pay out 25% of the value firm, you're essentially paying out like half your assets. I mean, it's a massive number, and it's a lot of money to send out all at one time. They don't really own hotels. It's a franchise business. So I don't know what asset, they didn't have to go sell hotels to pay for that, but you know, where do they get that money? That's a lot of cash to try to send out the door for a firm. All right, so we talked about the returns, arithmetic, geometric, how all that works. Let me, boy, I want to actually do this. Let's do this for Facebook. Or Meta or whoever it is. Now, was this the class I did Facebook the other day? I was like, yeah, so that someone says that was their European shares. And it made sense because if you adjusted for the euro, it came out about right. So here's Meta. We're going to get historical data. And what I say is the normal holding period. Daily, weekly, monthly. Monthly is the most common. So let's go back as far as we can. Let's bring in monthly data. Just like that, man, they had a big day yesterday, didn't they? That's a lot of shares traded. Is that one of their biggest days ever? Oh, word. Oh, no, this is monthly, sorry. I was saying, man, you know, I just said monthly and now I'm thinking daily and go, my word, that's not a good stock move. Your stock is down quite a bit, isn't it, though? It's a pretty amazing. All right, so we've got the data. What data do we need? So we want holding period return, ending market value minus beginning plus income. But we don't have dividends here, but we do. Where are our dividends? They've been already adjusted for us, adjusted close. Now, Meta may not pay dividends, so it may not be an issue. So if we eliminate everything but the adjusted close, and when you do paper 3, you're going to do the same thing. You're going to bring in the data, and you're going to do adjusted close. If you do that, we essentially, when we do our holding period, we do ending market value minus beginning market value or beginning, we've got the dividend in there because we're using adjusted close. So that's kind of the nice thing about that. So here's our holding period of return. So we take ending market value minus beginning market value plus income, which is 0, but really it's in the adjusted price divided by beginning market value. Huh? Oh, no, it should be on, shouldn't it? Pause. Why is it paused? I don't get that. Did I pause it? Right. Okay. Thanks. All right. So Apple stock didn't do too well in July of 2012. Didn't do too well in August. Didn't do well in September. Pretty volatile stock, isn't it? Didn't do well, obviously, last year or this year. So there's our number. So we got a bunch of holding periods. So what can we do with this? Well, we can get the arithmetic average. We can do geometric average. We can do standard deviation. We can calculate a beta. We can calculate systematic. Now that we have those holding periods, we can do all kinds of statistics on the stock. So you can see why that holding period is so important. You have to have someone calculate that number, and then we have to put a bunch of them together, and now we can do all kinds of cool things. This holding period by itself, one number for 1 month doesn't help us at all. You can't calculate a standard deviation on one number. You can't get an average on one number. But now that we have, how many numbers do we have? It's quite a few. So however many numbers we have, I can't see them because of that, but a lot of numbers. So now we can do pretty impressive things. So next class, what we'll do is we'll start calculating some of these things and then seeing how we can use that to make investment decisions, which is pretty critical.